September has proven to be a shaky month thus far. Danie Laurel sat down with BPI Securities President Narvaez, who weighed in on the many geopolitical issues that investors are concerned about. Let's take a listen.
We have to understand that the Fed is in a tough position. I think, one, the data coming out of the U.S. continues to be mixed. You have some signs of positive data. Consumption remains strong, but then you're seeing some slowdown in business investment, for example. I think there's also some concern as well about liquidity in the system. You never know with oil now. I think that was also in the back of their heads with oil going up, how that would impact inflation. Would it be too early to cut rates? So, given this volatility, even with the economic data coming out, I think the Fed felt that it probably wasn't a good time to already signal what they were planning to do for the next 6 to 12 months. Because you actually see that there's a lot of, different opinions currently among the Fed members. So they they're going to have to continue to evaluate the data. And unfortunately, it wasn't something that the market would have preferred. The market would have preferred the clear direction in terms of what they were going to do. So I would say the market reaction was, there was some disappointment.
Let's move on to oil, as you mentioned. So all of the supply issues contained for the time being. But the question was really the volatility on not just oil prices, but also possible geopolitical risks that this might happen again. Do you think that might cause a flight to safe havens, or again another second repeat of 2018 and a very cautious stance in the markets going forward?
I think generally our sense of the markets is I think people are going to remain cautious. Obviously, in the back of their heads, I think the key issue will remain the trade war. Some people feel that it could be resolved soon. Obviously, every time we hear of a potential meeting between Trump's group and President Xi's group as well, we try to bake in some optimism. But I think this is a big structural issue. This is something, I think the trade war is not just a major issue for Trump, but it's something actually that a lot of Democrats embrace as well. In some sense, it's quite a popular issue, because there's a sense that perhaps it's a bit disadvantageous for the U.S. At the moment. So I don't expect a quick resolution. In fact, it might drag on until even the 2020 U.S. election. And assuming Trump gets reelected, then it could drag on way past that, maybe a year or two before it gets resolved. So it's going to remain a source of volatility, and because it's going to weigh down on growth, I don't expect that equity markets are really going to probably see the multiples that we saw 3-4 years ago, especially with also rates normalizing as well.
Okay, so you don't think that investors or market watchers are drowning out that noise, since it's been there for some time already? All of these trade issues, like you mentioned, every time something happens, it jumps, and then are they not drowning that out and positioning for more fundamental issues, especially here in the Philippines? Or are they still taking that into consideration?
I think it's still so important, because obviously you look at the past 10-15 years, China has been such an important engine for growth globally. So assuming China slows down, there are second and third order effects. Obviously, economies now are a lot more interconnected than they were in the past. So slowing growth in China affects Australia, it affects Indonesia. Thankfully, the Philippines is not as impacted, given we're not so trade dependent. So in terms of how I see investors reacting to this information, I tend to think that there seems to be more of a short-term trading mentality among investors. They spot sudden distortion in the share price of a company that probably is unwarranted. They'll trade that, but it's a very short holding period. I don't sense, I sense less of a willingness to take on bigger bets, especially given this volatility.
What about the sense that they might actually be positioning in the Philippines as a bright spot, compared to the growth story here, still better than other parts of Asia? And also the idea that the government is pushing that we might actually really be benefiting from these trade wars in the long term if, they shift manufacturing in the Philippines. Do you feel this sentiment?
Well, I think there are certain, I would say the picture of the Philippines is actually quite strong, right? Obviously, the first half GDP numbers were probably lower than what we expected at the start of the year.
Right.
Obviously, that was really fueled by what happened with the delay in the budget passing. But you look forward 6 to 12 months, you hope, and maybe signs are there that the government will speed up the spending. You look at the first half numbers, private consumption was very strong,
Okay.
close to 6%. The issue really was business investment. In fact, it actually contracted year on year in the first half. But I think that partly had to do with how slow the government was in terms of disbursing their funds. We think that will pick up. We've seen also that rates have hopefully bottomed out. So I think people are going to start drawing on their credit lines, and they're going to then use that to invest or ramp up the investment in the second half. So I think the GDP number picture looks strong. Inflation is expected to continue to fall. We think it will probably fall sometime in September and October. But now there are some issues, mitigating factors as well.
Right.
I think chief among them is we think the peso will weaken. And then obviously this market is not the cheapest market. It really hasn't been one of the cheaper markets. And I think that's kind of holding some investors back, whether they think, given the volatile situation, they want to enter into a market that's not so cheap, despite the fact it has traded sideways of late.
But tell us your GDP projections.
Yeah.
Are you sticking to them being able to meet the 6 to 7%, especially with a couple of downgrades already streaming in?
We think it's probably going to fall at the bottom end of that range. I think 5.9% is our full year forecast, but we think it's going to rebound next year, somewhere closer to 6.6, 6.7% next year. We look at the breakdown of GDP. Everything was pretty much strong. Yes, business investment was kind of weak, but it really was dragged down by the budget because, as I said, consumption has remained strong.
Let's talk about the bourse and index levels here. We've been trading at a very, very thin range.
Okay.
And some are actually saying that's not that bad considering all of these headwinds. We haven't really dropped below 7,900 as much as could have happened, they say. Is there a psychological level that there's a support at 15 times PE, for example, as you mentioned?
I think it might be tough for us to go back to 15 times earnings, but there seems to be a certain resistance, which seems to be like the 8,050 level. Now the problem is, obviously some of these selling has nothing to do really with fundamentals. It's more technical issues. Chief among them really is the MSCI rebalancing.
Okay.
That's not going to be concluded until November of this year.
Right.
So my expectation, you're still going to see the impact of that. But I would say once we're done with that, sometime in November, assuming the market remains below 8,000, I think it would be a good time to enter.
Okay.
This year, it's going to be tough to eke out a lot of gains. Our index target for the rest of the year is about 8,300.
Okay.
But we think by the end of next year, 2020, we think the fair value of the market should be closer to 9,100. So you're talking about a potential return of 14%. That's typically above your cost of capital, which is about 11 to 12%. So overall, I would say I'd be a bit more overweight equities than I would under normal circumstances. I think bonds have been, there actually is some room potentially for bonds to fall further, given you've seen how low yields are at the moment. We don't think yields are going to stay, like 10-year bond yields at 4.6, 4.7%. I think there's going to be a bit of correction there.
How important are the foreign investors?
I think they are important, but I think local investors also continue to spot bargains. I think you still have a certain level of support from the locals because we know a lot of locals, they do have index-linked funds. They are fully concentrated on the Philippine market as well.